Welcome all. So now, after having talked about the three basic techniques of the risk analysis in the capital budgeting projects, I will take you to the next three techniques. They are little complex, but not that much complex that we can't understand, and they are very interesting tools where the mathematical models have been say developed to go for the risk analysis in the capital budgeting. So one important technique is called as the Hilliard's model, and in this Hilliard's model the very simple concept, though it looks very complex here, but very simple concept has been applied by a professor called as F.S. Hiller. So, if you see what Professor Hiller has tried to do to develop this model, he has done one thing is that he has said that there are the projects where the say cash flows are either correlated or they are uncorrelated, right, especially the cash inflows, right. So, because they are more important for say calculating the NPV of the project, whatever the outflow is going to be there, that is there largely in one go. It may be in the subsequent years also, but largely it is in the beginning. So, that outflow is fine, but inflow is coming over the number of years depending upon the life of the project. So, he says for explaining this model, he says that you have to divide the projects into two categories, or it belongs to either of the two categories. The project which is in question for the evaluation by us, the project either may fall into the first category where the cash flows are uncorrelated, or second category where the cash flows are perfectly correlated, right. So, when you are talking about the uncorrelated or we are talking about the perfectly correlated, means what does it mean? That normally we see that we have seen two kind of cash flows while evaluating the capital investment proposals. One was that we were keeping the cash inflows like a cash outflow, as it was say only in the zero period, or in the current period we were considering cash inflow, we were considering as a constant cash inflows, that for example 200 million are going to be there in the first year to last 10 years, or maybe in the previous case also where we discussed the financial break even point, we also considered that the cash inflows will be constant or they will be correlated. You can say they are going to be constant means correlated. So, we can easily find out that what is the cash flow in the first year, same amount of the cash flow is going to be the second year, third year, fourth year, or even the change in the cash flow is going to be there. Even then that is a predictable change, that yes, we will be increasing our sales by 10%, which is in our hands, does not depend upon the market, that is in our hands. So, we will be selling for 200 millions in the first year, next year we will be selling for the 220 millions, and then we will be increasing the sales at the rate of the 10%, maybe of the base value or maybe of the say the previous year. So, if it is possible to correlate the cash flows, then it is the one category of the project, but sometimes the project may fall into the category where the project where the cash flows, especially the inflows, are uncorrelated, right. So, if the cash inflows are uncorrelated, it means the element of risk is high. The projects where the cash flow is correlated or the perfectly correlated, then you can say that the element of risk in the project is quite less, but those cash flows where the say which are say correlated cash flows, the element of the risk is quite high. So, he has applied the concept of the standard deviation of the say cash flows. So, he says that we should calculate the expected NPV from the project, right, and then we should calculate the expected standard deviation of the cash flows from the project. So, it means you can say NPV, when we calculate, what we do, we simply sum up the cash inflows and then discounted, we are talking about discounted cash flows, cash inflows, we sum them up, and from that figure of the discounted summed up figure of the cash inflows we subtract the cash outflows. So, we are left with NPV. So, in a way you call it as, that is called as the say an expected NPV is basically the mean of the cash flows expected over the life of the project, and standard deviation you can call it as, another name of the standard deviation is variance. So, he has applied the concept of mean variance analysis on the risk analysis of the capital budgeting projects, and he has proposed that we should try to find out that if the cash flows are correlated, perfectly correlated, then what is the expected NPV from the project and what is the expected standard deviation of the cash flows of the project, and if they are uncorrelated, then both the things should be calculated. So, what happens that if the higher the amount of NPV, expected NPV, and lower the amount of say standard deviation of the cash flows, then what is the situation? Project is least risky as compared to the situation when the say expected NPV of the project is lower and the expected standard deviation is very high, right, because standard deviation is basically called as the synonymous to risk. When in the financial terms we go to measure the risk in the market, whether you call it as the mean variance theory of the say portfolio theory, which is basically given to us by the Harry Markowitz. So, that theory which is called as a portfolio theory, which is basically the base of the CAPM, capital asset pricing model, which we use for calculating the cost of capital, which we use for the calculation of the cost of the capital. In the next topic we will discuss the CAPM, capital asset pricing model for discussing or calculating the cost of capital. So, that is the base of that CAPM is the mean variance theory, or you call it as the portfolio theory given to us by the Harry Markowitz. William Sharpe has given us the CAPM and Harry Markowitz have given us the portfolio theory. Both are awarded the Nobel Prize for their contribution into the financial economics. So, here the Hiller model also says, or F.S. Hiller also says that while applying this concept, means in this case when applying this concept of the say risk analysis in the capital budgeting, we should try to first of all try to find out which category the project belongs or falls into, whether it falls into the category where the cash flows are uncorrelated or it falls into the category where the cash flows are perfectly correlated. If it falls into the category of the cash flows uncorrelated, then be careful, right, because the element of risk will be very high, because when you calculate the standard deviation of the cash flows in the different years, you will certainly find the standard deviation will be very high, right. So, one point of caution, but if the cash flows are perfectly correlated, so means the next year's cash flow is correlated to the previous year's cash flow. So, you can predict the changes in the cash flow and we can understand certainly there the level of sigma standard deviation will be quite low, and if the level of standard deviation is quite low, it means the level of risk is too low or quite low. So, what is written here? Just read the important points for your understanding. First thing, under certain circumstances, the expected NPV and standard deviation of NPV may be obtained through a mathematical model suggested by F.S. Hiller, right. So, F.S. Hiller has suggested this model, and what he has said, two cases of such analysis are discussed here: no correlation among the cash flows and the perfect correlation among the cash flows. No correlation among the cash flows and perfect correlation among the cash flows, right. Next thing what he says, when the cash flows of the different years are uncorrelated, when the cash flows of different years are uncorrelated, the cash flows for the year T, the cash flow for the year T is independent of the cash flow of the year T minus M. This is a very important line. When the cash flows of the different years are uncorrelated, the cash flows for the year T, for the cash flows for the year T is independent or are independent of the cash flow for the year T minus M, right. If the cash flow for the different years are perfectly correlated, the behavior of the cash flows in all periods will be alike, right. So, you can understand either we have the constant cash inflows or even they are changing in a predictable manner, in a predictable fashion. For example, you can draw the true trends like this, the one cash flow is moving like this, right. So, you have this level, then you have this level, then you have this level, you have this level. So, it means you can understand that what is the level of this standard deviation. This is very high level of standard deviation, you cannot predict whether we will have next year we have this level. So, we will have this level of the cash flow, we will have this level of cash flow, or it will fall down to this level of cash flow. Whereas, in case of the correlated cash flows, either you can have a straight line if they are going to be the constant, or even they are rising also, they are rising in this fashion, right. They are not creating a situation that, or even if there is a rise and fall also, you can say that it may go like this, it may go like this, right. So, it is something like this. So, it means if it is, we say that initially it was there, it reached to this place, so it may come down to this level. So, they are correlated to some extent, but more level of correlation will be exhibited by this, when it is the constant cash flow or it is growing up in a predictable fashion, it is considered as a perfectly correlated, because this year's cash flow is impacting this year's. So, this year's cash flow depends largely or is correlated to this year. Similarly, you talk about these years. So, it means you can easily find out what is going to happen with regard to the cash flows, and in this case it is very easy to find out the cash flows, that how they are, whether they are correlated or not correlated, or what is going to happen. In this case the standard deviation, if you calculate of this particular trend, it will be very high, but in this case if you calculate the standard deviation, means in this case it will be quite low, in this case it will not be there at all, because the cash flows are constant, they are moving in the same fashion or in the same design. So, further he says, if the cash flows for the different years are perfectly correlated, the behavior of the cash flows in all periods will be alike. You can understand, you can predict in advance. It means where you can predict the cash inflow, the element of risk is very high, because level of standard deviation in the cash flows is very high, is very low. The level of risk is very low, the level of risk will be very low, not very high, because you can easily predict that how much is going to be the cash inflow in the next year or in the next 2 years, 3 years, 4 years, 5 years or 7 years or 10 years, right, because they are perfectly correlated. So, level of risk will be very low, because level of sigma or standard deviation of the cash flows is quite low, but where the trend is something like this, right. So, it means standard deviation is very high, and higher the amount of standard deviation in the cash flows brings the higher amount of risk. So, this is the simple concept of mean variance analysis has been applied by F.S. Hiller, and finally he says, thus the NPV, expected NPV and the standard deviation under these two circumstances are calculated. So, it means what we are doing here, this particular model is helping us to calculate the expected NPV, where it is n is the number of years summation of the cash flows, CT is the expected cash flow, and this is the, you can call it as I. Yes, this is a point of difference here. I is basically what? I is basically the risk free rate of return. I is not the cost of capital, it is called as RFR, it is the risk free rate of return. So, it means we discount it with the risk free rate of return, minimum you call it as. What is the minimum rate of return available from the risk free? Means no risk involved in that much of the return is always available. For example, you have two options. If you have your surplus savings available, if you give your savings to the bank or you deposit them in the bank, it means the rate of interest being offered to you is the risk free rate of interest or the risk free rate of return, because bank is certainly going to return you that much rate of interest or that much rate of return. So, it means you are totally risk averse, you do not want to take any kind of risk, though you are satisfied with the say given return or rate of return by the bank. So, that is called as the risk free rate of return. But the investor, if he is not satisfied with the by the returns given by the bank, so he has a number of options. He can invest his savings into the real estate, he can buy the stocks, or he can go to the stock market and invest into the shares of different companies. So, the moment he goes to the real estate market or the moment he goes to the stock market, he is considered as the risk neutral, and he is ready to take the higher amount of the risk for the want of higher amount of returns, right. So, how much returns you want, accordingly the level of risk will be there. So, in this case we are saying that the minimum return, which is a risk free rate of return, which is taken here as I, it is not cost of capital. Normally we use the cost of capital as the say a discount rate, but in this case we are saying that that level of return should be known to us, which is a risk free rate of return. If any project is not able to return even the risk free rate of return, then I think the element of risk is very high in that project and we should not go ahead with that kind of the investment proposal. So, here you are calculating with the help of this is the say model for calculating the expected NPV of the project, and with the help of this model you can calculate the standard deviation of the cash flows occurring in the different years. And in both the cases, whether it is the uncorrelated cash flows or whether it is the perfectly correlated cash flows, in the first case we have calculated the expected NPV, we have calculated the expected standard deviation. So, NPV indicates the or represents the average returns available from the investment proposal, and this indicates the element of the risk associated with that proposal. So, our decision criteria should be, or to define the risk or to look at the risk in this kind of situation is, only those projects should be say undertaken or should be accepted where the average expected return is quite high and the expected standard deviation is quite low. The projects which give us the high standard deviation but low average returns or expected NPV, those projects should be abandoned. We should not go ahead with making investment, because for the existence of high level of sigma or standard deviation, the element of risk associated with those projects is very high. So, this is a simple model, theoretically I am explaining it to you. So, we can easily calculate the average returns we are calculating, expected NPV we are calculating, and we have to calculate the standard deviation of the cash flows also, right. Again you have the two distributions, one distribution is here that for example the cash flows is 100, then you have 200, then it is 300. So, it is a correlated cash flow 400, 500, 600, right. So, you can calculate the average return, we are doing it, we are discounting it for the discount factor, say for example 12%, and it may be the I, risk free rate of return. So, we are discounting it for that, and once we are discounting it, we are calculating the discounted value or we are calculating the present value, right. So, we are calculating the present value of all these. Once that present value of the cash flows is calculated, we are summing up this present value. So, this plus this plus this plus this plus this is known as the expected NPV of the project, when from this present value of the cash inflows, when you are subtracting the present value of the cash or outflows. So, the net result is going to be the NPV, and we bar here it is, that is expected NPV. Similarly, from this distribution, if you calculate the sigma by following the root of the variance, first you calculate the mean, and from the mean you calculate the variance, and variance you calculate, and when you take the say this finally from the variance you can easily calculate the standard deviation. So, it means variance also itself is the indicator of the risk, mean variance, right. So, variance, even you leave it at the variance level. So, variance is also the indicator of the risk, and when you want to convert the variance into the standard deviation, you can convert that also. So, both variance and standard deviation say communicate the element of the risk, higher the level of standard deviation or variance, because if these cash flows are highly variable, then you can understand element of risk is very high. So, by calculating the from this distribution of the cash flows, future cash flows, cash inflows especially, if you calculate the expected NPV and if you calculate the sigma, so you can understand what is the element of risk and decision criteria, as I am repeatedly telling you that higher the NPV, lower the sigma should be our decision criteria. If the reverse happens, the project is not worthwhile, it should be abandoned. So, simple concept of the mean variance has been applied by the Professor F.S. Hiller, and this model is popularly called as the Hiller's model, right. So, this is one technique. Next technique is, now we move forward is with the simulation analysis, right. And after this we will talk about or we will discuss the say your decision tree analysis. Simulation analysis is it is a operation research technique basically, but now sometimes we have started applying it for the project evaluations also, especially for the risk analysis in the project capital budgeting proposals. So, simulation is basically, because it is a very complex process, it is not possible to be done manually, though we do it on the systems on the computers, but manually also it can be done if the situation is very simple, and there if the say total calculations to be done are not very complex, right. So, simulation, as the words communicate or this term communicates, simulation means to simulate something, to simulate something. So, it means under simulation analysis what we do, we create an artificial model of the project, we create the artificial model of the project where we predict everything depending upon the DPFR, information given in the detailed project feasibility report. We try to put all the things at the respective places, and we, with the help of simulation process, which is a methodology technique, we try to create the model of the project, and then we try to see whether this model looks worthwhile or not. So, why we need the computerized analysis? Because many a time you have to change the figures to arrive at the acceptable estimates. So, here when you talk about the simulation technique or the simulation process of say risk analysis, here is the procedure given here. Number 1, point number 1 says model the project. This point says model the project. You have to convert the whole project into a model, and what it is written here? The model of the project shows how the NPV is related to the parameters and exogenous variables. How the NPV is related to the parameters and exogenous variables. What are the parameters now? Parameters are the variables. Parameters are the variables specified by the decision makers and held constant over all simulation runs. Overall simulation runs, whereas the exogenous variables, if we talk about these, exogenous variables are inputs or the input variables which are stochastic in nature, very volatile in nature and outside the control of the decision makers. So, what you have to do is you have to identify the parameters. Now, what are the parameters? Parameters are like say for example, which remain constant. First of all, cash outflow, right. Then you talk about the cash outflow means investment, and then you talk about the cash inflow, and then you talk about the different parameters here, that in case of the say for example, let us go back to the sensitivity analysis. If you go back to the sensitivity analysis, means simulation analysis is sort of a technique which is the advanced version of the sensitivity analysis, Under sensitivity analysis, what we have done? We change one variable at a time. We change investment, then we see what is the impact upon NPV, then we change sales, what is the impact upon NPV, then we can change the variable cost, then we can change the fixed cost. So, one variable at a time, but the problem there we face is that we are not able to establish that how likely the change in the sales is going to be there. How likely the change is going to be there, how likely it is that the variable cost will be changed and it will be this much, how likely it is that the fixed cost will be changed and it will be this. That likelihood is not possible to be established in the sensitivity analysis, but in the simulation analysis we remove that limitation, and in that case we try to find out what are the parameters, means what is the cash inflow outflow, what is the cash inflow in terms of, means for calculating the cash inflow you have to follow the sensitivity analysis, and in this case you have to determine these parameters, and these parameters are given to here to you are, for example, investment we have to find out, sales, variable cost, fixed cost, depreciation, pre-tax profit and taxes. These parameters are known as a constant parameters. Cash outflow will be there, sales will be there, both the costs will be there, that is a fixed cost and the variable cost, depreciation will be there, tax will be there. All these things which are going to be constant, they are known as the parameters. But what are the exogenous variables? Exogenous variables are their values, these values here. These values are not in our control. If you want to sell certain amount of quantity in the market, to some extent we can try, but largely that depends upon the market situation. Similarly, when you talk about the investment, when you want to make investment, we have pre-estimated the investment we are going to make, but they are sometimes out of the control also, that when we started building the project, the prices of the steels went up, or when we want to say build up the project, labor prices went up. So, it means it is beyond our control. So, both the variables we have to identify, that is the parameters and the exogenous variables. Once these variables are, one are constant, another are stochastic, highly volatile. So, one is sales are going to be there, how much sales are going to be there, that is exogenous factor, right. Similarly, variable cost is going to be there, that is stable, for sure we know it, but how much variable cost is going to be there, we have estimated, but it can change also. So, that is called a simulation, that you change the variable cost, change the figures time and again. If this is a variable cost, what is the result? If this is a variable cost, what is the result? And then how likely we are able to establish with the help of this technique. So, simulation means creating a prototype of the project on the system, not physically on the system, and then means taking all the information into account, trying to find out whether it is going to be as per our expectations or not. If it is not going to be as per our expectations, then I think it is better to abandon the proposal, but if it is going to be, then so you can change, means the flexibility here is you can change the figures time and again, and you can see the impact of the changes. So, you have to model the project. Second thing is specify the probability distribution of these variables. Probability distribution of these variables, that what is the likelihood this much of the sales will be there, this much of the variable cost will be there, this much of the fixed cost will be there. Probability you have to assign depending upon different estimates. Either you can see the say figures from the existing firms or the information sources, or you can take the help from other sources, but you have to assign the probability somehow. Then draw values at random and calculate NPV. So, it means after say putting the values, whatever the values we want to say for example, sales in the first year will be 100 million, second year will be 150 million, then will be 200 millions. So, it means they are basically the say the drawing the values at random. At random we are writing here, but they depend largely upon the market and demand analysis, and assign the probability that when we went to the people, what was their mindset when they were responding to the question, right. So, I think people were largely serious about it, because the product we are going to manufacture, it is going to fulfill one of their necessities. So, I think they will certainly buy it. So, probability can be 80%, but if you go to non-serious respondents, probability can be 50%, he may buy, he may not buy, right. So, like that you have to change it. Repeat 3 you can call it as repeat these steps. Repeat this point number 3, you call it as repeat point number 3 many times and plot the distribution. This is the random, draw values at random. So, you can say when you talk the value of random, so you can say it can be 100 million also, it can be 150 also, it can be 75 million also. So, repeat step number 3 many times and plot the distribution. After that, applying the probability and these values you have to change. So, if you change these values time and again, it can be 75 million also, it can be 100 million also, it can be 150 million also, and whatever the probability that we have assigned. So, multiply those figures with the probability, and then the expected value can be calculated, and that distribution can be plotted, right. And on the basis of that, whatever that total means the relationship between the cash outflow and inflow, depending upon the level of sales, depending upon the level of fixed cost and the variable cost comes up, that can be worked out. So, it means we have created a project where any kind of changes were required, we have done that, and we have developed different kind of distributions by changing the different say exogenous variables, not parameters. So, values we have changed, randomly we have applied the values, we use the word randomly, but we are say basing it upon some estimates and then multiplying it by the probability estimates, then you can easily develop that distribution, and that distribution when means plotted on the paper will give us some idea about whether the project is going to be a worthwhile proposition or it is not going to be a worthwhile proposition, right. So, this is the simulation analysis. I am not doing any problem here with regard to the simulation analysis. So, for the detailed reference of this Hillier model as well as the simulation analysis, one simple problem has been discussed in the book which I time and again refer to, Financial Management by Prasanna Chandra. If you refer to that book in the say risk analysis in the capital budgeting proposals, author has say explained how the simulation model will work, but there also the author has admitted that in fact the simulation can be applied with the help of the computers or with the help of the softwares, but still for the sake of simplicity and understanding the simulation analysis well, the author has done one simple example. So, if you want to learn practically that how simulation analysis can be used in the risk reduction or the risk analysis of the capital budgeting proposals, you can refer to the book. So, after this, these two techniques, technical say methods or mathematical approaches like Hillier's model as well as the simulation analysis, next thing is the decision tree analysis. This technique is very interesting technique. You must have say heard about this technique, decision tree, where we try to find out that yes, if there is any decision to be taken, we can say that this decision may be taken, may not be taken, right. If we take the decision, what is the probability of success? If we do not take the decision, what is the probability of say not taking, or if we take the decision, what is the probability of success, what is the probability of failure. So, should we make investment, should we not make investment. So, we develop a tree, right. We try to find out what are the possible outcomes, and with the help of those outcomes we try to assign some probabilities. So, we try to find out certain decision points and certain chance points, right. In the decision points we say yes or no, or we propose different options available, and in the chance point we assign the probability to those options or those decisions, and then we try to calculate again the NPV of the project, and with the help of that NPV we can decide about whether to go for this project or not. So, how this decision tree will work and what this technique is, I will discuss this technique with you, but not now, in the next class. So, till then means you should read, you should try to understand what are other than the first three techniques like sensitivity analysis, scenario analysis and break-even analysis, what is the Hiller's model, which is basically a mean variance analysis. It looks a very complex model, but it is a very simple and interesting model where the expected NPV and expected sigma or the standard deviation is worked out. NPV represents return and the sigma returns the risk in that model, and simulation is all we understand. Simulation is basically the say creating the project on the paper by changing the different variables which are say you can call it as exogenous variables, the values of that, assigning the probability and trying to find out that in the best possible situation how the project is going to behave, and in the worst possible situations how the project is going to respond, and whether to finally go for the project or not. So, these were the means till now we have completed the 5 techniques, and the last technique, that is a decision tree analysis, again most interesting, most useful technique, and how we can use in the risk analysis of the capital budgeting proposals or the new investment proposals, that I will discuss with you in the next class. Till then, thank you very much.